Greetings, everyone. This is Jeff Scott. Welcome to this weekend's review. This is a beautiful picture that I took a short while ago on the Amalfi Coast in Italy, where I took my lovely wife for our 30th anniversary. It is 10:30 in the morning, so obviously on Sunday the 9th, futures are not available. So let's get started. I titled today, as I like to title things, Breadth Narrows, and really the main question, will support hold? I mean, to be blunt, we are in a very critical junction in most of the indices, and it'll be interesting to see whether or not we can bounce here as we've bounced multiple times in the past, or is this something worse? And all this is in the setting of worsening breadth. As always, this is for education purposes only. I'm a doctor, not a broker. I am not affiliated with any software vendor or trading company. The tools demonstrate those that I use in my daily trading, and I have paid for all the tools I demonstrate. Trading involves risks. You and you alone are solely responsible for any investment decisions you make. I talk a lot, well, occasionally I talk about options, and I want to, just call out the fact that options can be risky and are, to me, they're a less risky instrument because if I'm buying, I can control my losses. But as I'll mention throughout, at some point today, I had sort of an option surprise this week, which sort of demonstrates some of the risks that you need to be aware of. I'm not going to spend much time here. Please refer to prior films, or prior videos rather. Just for the basics, I'm certainly schooled in CanSlim, taken to a different level by Morales and Catcher, automated by Ian Woodward and Ron Brown. I've spent a lot of time reading and participating in some of the programming that Alexander Elder does. Van Tharp for position size and money management, and really am a big fan and actually friend now of my mentor John Person, author of many books, Trading Systems, and I incorporate his tools into my trading on a daily basis. I have lots of programs, way too many programs. I once had a contest to see if anybody come up with a program that I don't own, and unfortunately they did, and I bought it. It was called Sentient Trader. That I used it for about a week, and like other programs, it sits on my desktop. I need a real-time charting platform. I like both TradeStation and Thinkorswim. I think there are certain things that I can do at Genesis I can't do with the others, but I'm not advocating that people go out and spend $2,000 for the platform and another $1,000 a year for the data. One of my challenges is I bought a lot of the plugins, which I find very useful, including John Person's, and I think I keep it going because of the plugins. From a post-market and intra-market, I do my analysis with HGSI and EdgeRater. ETF Bandit would be for someone who trades mostly ETFs that's interested in a sort of a black box buy-sell program that's an offshoot of EdgeRater. I own all the seasonality programs, and I use a number of websites. So I like to always start by taking a look at where we ended the week. And I won't say it's a sea of red because there's certainly islands of green. Specifically, the utility sector had a lot of positivity this week, essentially the end of the week rather. I think with rising rates, that's a negative for the utilities. However, with concerns about being defensive and topping, utilities might outperform, as might things like REITs, which we saw some strength in as well, especially at the end of the week. Casinos starting to bounce, more and more evidence perhaps that Macau is slowing, but you could also play things like Isle of Capri, which are, and Boyd Gaming, which have no or minimal exposure, if any, to Macau. Airlines had a decent week, but sold off some on Friday. Again, looking through here, you could see that insurers and banks and the overall financials mostly red, and I think that might be telegraphing, as with is the strength in REITs and utilities, that despite all the talk on CNBC, maybe we're not going to see a big increase in interest rates or any increase. And gold continues to give one-day wonders. ABX had an upgrade on Friday, otherwise the sector was down. So I look at this, and it's certainly not an up day, but I guess if I looked at it at noon, it looks a lot better than it did at noon. And hopefully it'll come back to that point. I started covering shorts in the last hour and a half, 2 hours when the NDX bounced. So I'm a lot less short going into Monday, which may or may not be a good thing. So part of what I think the story is here is that we've got different markets, and this won't show up great. So actually, let me do this. That's not the one I want. I have a lot of indicators at the top, so I don't even have to look at the chart, so I can know what's going on. I can look at the market anytime during the day. And when the market's doing well, there's a lot of green here, not a lot of red. This is the S&P on a daily chart, the E-minis. And you could see the E-minis have pulled down to the 200-day moving average and held. That's a pretty big story. We've pulled down to 2032-ish, 2030-ish in June as the lows here. We're higher lows here, but also lower highs, and we're sort of getting into, I guess, kind of a wedge or triangle formation. But we were on the 200-day moving average, which might be a natural place for a bounce. And we did, very much so at the end of the day, come off of that on Friday. The NASDAQ, the NQ, NASDAQ 100, has pulled back to the yellow bar, which is the 50. So the NQs look a lot healthier than the E-minis, as they're not even below or their 50-day moving average. I want to talk about what's not healthy is the YMs, or the Dow futures and mini Dow futures. As you could see, we're getting lower lows and also lower highs. I talked about last week that we're probably in a downtrend now, at least a short-term downtrend on the Dow. And you'll notice a paint of a low here, which means a lower low, and also lower highs here, lower highs also on the Russell. And the Russell has broken through the 200-day support as well. So is the story the NASDAQ, which is holding up and will lift the rest of the market? Is it the E-mini that's fallen down to major support and will hold here and help to bring the market higher? Or is the TFs, the Russell futures, and the YM, the Dow futures, which have broken below major support, and I mean major support, I think, on this Dow, is that more indicative of what's to come? Now, interestingly, despite what looks like in the YM and the Russell is a tough market, the VIX, will look at it on other views, is struggling to get above the 50, and the dollar is now being supported by the 17-day moving average. So to me, these moving averages matter. I'm bothered by the lower lows and lower highs on the TFs and the YM. Interest rates. On the week, they were down a teeny bit, 1.3% prior to the prior close. And now this is, to me, a very telling thing. As I said, I saw strength in REITs and utilities. That would suggest we do not have a rate hike coming in September. Listening to the talking heads, you get a totally different impression. Current rate sitting on the 200 and the 50-day moving averages, which might be support. So if we bounce here, that's going to be more consistent with the incoming rates. And as I've said in the past, falling rates are good for REITs, MLPs, utilities, dividend payers, and home builders. And rising rates are good for banks, especially the regional ones and the insurers. I've been showing this over the last couple of weeks. It's not good when red's above black. That means the selling pressure is above the buying pressure. Lowry and Investec Research, a second research company, are two companies I actually pay to subscribe to, mostly to get their calls about the overall state of the market. And both of them have a long an illustrious history of being able to call market tops and get their subscribers, at least warn them of impending bear markets. The red over the black is a bad sign. This kind of tells me the indecision of the market, because over the last month or so, a little bit more than a month, we've kind of been going flatline here with the red and the black oscillating above and below. I think that's what we feel the chop, but certainly risk is elevated here. Now, imagine that this was a stock. This is really the AD line. Now, you've got a shoulder and a head, and maybe we'll rise up and get another shoulder before he rolls over. But if this was a stock, it's cut through the 17, it's cut through the 50. Here's the 200. Which way do you think the stock is going? Well, I think the stock is going down. If our AD line continues to fall, then that will bring the overall market. Now, this is a McClellan Summation Index, and I look at it for two reasons. One, I look at for breadth, and clearly the amount of participating stocks in the market of going up is getting smaller and smaller. And the other thing is you look at prior pullbacks in the market and the level of the McClellan Summation Index, and we are getting close, but not necessarily to the extreme point where one expects to see a bounce. So maybe this is telling us, and I think I'm looking at the spiders here, that we're getting close to a bounce from a market participation perspective. Other evidence of market participation, you have a weekly of the spiders in white, and in green you have a line chart of the stocks above the 200-day price moving average. And you could see, in fact, if you look at when you see a pullback in the index, you commonly see a pullback in the stocks above 200 days. Pullback in the index, this was a pretty severe one, probably the biggest one. This was in the October 2014 era, and you could see how far back down the number of stocks above the 200 were. So again, like in the summation index, we're pulling back here, but we're not at the super extreme levels, although we're at a lot higher, amount or lower on the curve and a higher number of stocks below the 200-day moving average than we have been in the recent past, except for this spike down. Again, evidence that you might expect to see some type of a snapback rally coming. Stocks above the 40, the same story. The number gets lower and lower, but not quite to the extremes that we saw back here. So less and less stocks above the 40-day SMA. Now the canaries are, as you can see in the little box here, sort of the leaders in the market over the last couple of years. And we've used this list as sort of a all clear signal of when it's, or danger signal. And I've commented over the last couple of weeks that they've certainly held up better than the market as a whole. And frankly, some of these stocks are probably why the NQs look as good as they are. Now, what's interesting here is not all canaries are in sync. If you think about Priceline and Netflix, they're breaking out to new highs or have been at new highs. Apple, LinkedIn, and Tesla are in the dumps. And after big moves, Amazon, Facebook, and Google are neutral. In fact, those guys kind of look like this. So the Canaries Index is actually looking like it's pausing to refresh, and maybe we've got ourselves a little bull flag here, and maybe it's going to run again off that 17, but I'll continue to watch that. Certainly stronger than the rest of the indexes. These are some stock chart stocks, and I saw a presentation, and I realized how easy it was to make them. So I thought I'd look at sort of what we've been living in. I mean, everybody keeps talking about we're overdue a 10% correction. We've had some corrections in this sideways market. As much as I believe is not necessarily reality, believe is just my guess, that we're topping and this market is rolling over. One could argue that if you go back to since we've been sideways in February, there's been a sort of a rolling correction. And over that period of time, for example, energy is down 15%, materials are down 10%, industrials are down 4.8%, and this is over a 120-day period of flatness in the market between February 18th and August 7th. So I still believe that this market is toppy, but I softened my stance last week a little bit and said and that if we keep going sideways long enough, we'll get into late September, October when the market could go to the upside. And I also remember from sort of a more macro perspective that we are in year 7 of a 2-term presidential cycle, year 3 of the second term, and this is not a typical year for the market to do poorly. In fact, in this year 7 since 1900, I don't think there's many, if any, times that the overall market has not been positive. And then the other part is we are in a campaigning year where it's typical for money to be spent in D.C., which helps to prop up the markets. So rolling correction not affecting everybody equally in the sideways move. If I look at the last week and the last month, you can sort of graphically see a couple of things in that utilities and financials, and the third guy here, which is I think it's consumer staples, were up this week. Technology and cyclicals up a little bit. And what's interesting is, make sure I get my colors right here. Healthcare over the last week, and healthcare has been a stellar performer. Healthcare was down. The only thing bigger down than healthcare was the cyclical stocks. So a little bit different look to the last week than we did in the prior weeks. And again, is this part of that rotation of going out and getting shot while other sectors recover? And so instead of seeing that big sell-off, are we just going to continue to see a sort of a sector industry specific sell-off and while others rebound so that the market remains relatively choppy and range bound? A couple other things that this was something that John, person I was sitting in the office, he sent me a note and said, look at margin debt and cash. Well, here's margin debt on the left on the NYSE. Through the end of July, here's margin debt on the NASDAQ. And I guess the point of this is, especially on the NYSE, our margin debt is getting to the point where it's as big as it's ever been. And now if you look at that, and you look at what happens in the past when margin debt gets high, it doesn't necessarily equal a sell-off in the market, but typically the market starts to peak shortly after the peak in margin debt. So we are extreme on margin debt, and when that turns down is probably the point that we need to be nervous, but more evidence that this is a market in perhaps danger zone. And then who's going to be the one to buy my stocks if I'm very long and I want to get out of the market quick? And this is just showing that not only is margin extremely high on the NYSE, and maybe this is sort of consistent with that, available cash is as low as it's ever been as well. And that would, and I would mean that everybody's all in, or we're all in on July 30th. And if you're all in, then who's left to buy your stocks? That's the problem. So market thoughts, short-term likely place to bounce here. Seasonally, August is okay for equities, but September is worse. Old support starts to be resistance. That's concerning for things like the Dow and the Russell, which have broken below their 200. And I think short-term sector rotation continues as Wall Street takes down one industry while the next recovers. And I want to emphasize, I have a tendency to be overly bullish in these talks. I don't spend much time looking at shorter stocks, and frankly, in my own portfolios, I buy puts and I buy contra ETFs, which allows me to sleep better at night than shorting a lot of stocks. But this is not a time to go all in. Longer term, I still think, as I've mentioned, that this is topping action. I think that the first rate rise is more symbolic, but then once they start raising rates, the fear is going to turn to how fast are they raising them. Economic strength versus a rising interest rate environment is going to determine the fate of the market. If they start raising rates because the economy is humming and earnings are growing and everybody's happy, then that still could be positive on the market. And, you know, we've gone through, let's see, China multiple times, Greece. I saw something come up on Saturday's Wall Street Journal about issues with Greece again, interest rates. What's the next shoe to drop? I always keep these slides in, not because you haven't seen them every week for the last 5 years, but because to remind you and me that stocks are cyclical and you can't be the same positioning in the market 100% of the time. We have been living at this top here. You could just cut off the top 5% and just we're doing this oscillating until we decide whether we're done correcting and we go up, in which case we start all over here, all in, or are we more likely to roll over into a state of fear and it's time to be short or out of the market? I don't think we have an answer. I mean, I certainly lean towards the we're going to roll over eventually comment, but I'm not 100% in that. So I'm living on the top, which means I raise cash. I have the highest cash position now that I've had maybe ever in my life, not percentage-wise, but just my account's grown. So, you know, the fact that I have cash to the amount that I have in my account is remarkable. I have smaller position sizes, and I've sold premium, which means if I own a position long-term, I might be selling calls against that position. I might be buying puts. I might be buying a put to protect price and selling a call to pay for that put, and maybe selling a put way below the put I buy to sort of help finance the put. And as we go into that stage of fear, I will be looking to put on more negative bear call spreads, buy put, sell call, short stock, and contra ETFs. Good news is that earnings season is coming to an end. You have a list of who's still coming in, but compared to last week, it's quiet. And economic releases, we still got some PPI and sales and some claims, but we got through the monthly unemployment. And I'll leave you with my comment. You can read it yourself, but basically, you better know when your earnings come out. I will occasionally, now let me say this again. I will hold stocks over earnings. I will try and assess what my risk is. I may consider buying puts to protect myself, but it's really bad if I have an earnings surprise and I didn't know I had earnings coming out. I can't help it. I can't help it when the there's an announcement that wasn't planned, i.e. a warning, but I can be prepared for the scheduled dates and have protected my portfolio. So last week I started something. I had a lot of positive comments. I hope this will not be just a case of beginner's luck, because considering a tough market, we had a great pick, and I hope some people besides me traded it. I did mention that I may not take the trade because earnings were coming out, and I know that a couple people commented, why did I say that if I was taking the trade? And I think it's very simple. Right now I'm talking to the masses. I don't know your risk. I don't want to be overly bullish when earnings are coming out in 3 days, so I have to tell you. But I may be willing to take more risk. And if I like the chart and I could come up with something that meets my risk tolerance, I'm going to take it. And I really like this chart. And as you'll see, this is the setup that I look for every day of every week that I trade. So the stock was AMSG, AMSG Corporation. And this is my favorite setup. I have a lot of names for this. If you're in HGSI, you would have found this on the pullback to the 50 with the Kahuna scan. You would have also picked it up the day before, I think, on the PSAR close and a squeeze. I have a stock that's clearly in an uptrend that is pulled back short term to the 50. That's one of my favorite setups. In addition to that, I have a number of momentum indicators that came in the day before I took the trade. This is Friday. I took the trade on Monday. Now, typically in the market, I would have taken this trade on Friday. I had a kahuna down here. I had a pocket pivot. I had a mobile breakout from a squeeze, and my distribution went to neutral. Everything else is green up here. So I really had the perfect storm of my indicators that I follow. I'm making money with acceleration of earnings. And what on my TradeStation setup, I pointed out that it had what's called a high close doji, which is from John Person's work. That's a very high probability signal. And when you see a high close doji, either take it at the close of that day or you take the buy at the next day. My indicators were positive, as you see down here. And so when I presented it last week, I said closing price was 71.74 in the prior Friday. High was at 71.80. These are some of my considerations for putting in my stops. I'm relatively conservative, so I said I'll take the 67.65, which is right below the lowest recent close. So I assumed a buy at 71.80, a stop at 67.65, a risk of 5.8%. I went through last time the various trades. I like to do spreads to offset some of my costs, and I think I would have been better buying stock or calls outright. I did a bull call spread, meaning I sold a call and bought a call. I bought the close-in call. I sold the far-out call, and you could see the results of my trade are sitting below. It was a very nice trade. I bought more than I currently have. On Tuesday or Wednesday. Tuesday, I think, was earnings. Whatever day earnings came out, I can't remember if it was Tuesday or Wednesday. I went and sold off part of my position, because I was up already, and I used it to protect some my investment, and then I let the rest run. And you could see it's been a nice trade. I'll take a return like that in 1 week's time. Here's the two positions. Here's the current profitability, and this is on 30 calls, which means 3,000 shares. If you've never done an option, don't do an option, get educated. But what basically happened here is I bought the right to buy 3,000 shares at $70. I bought the right to sell, or the obligation to sell those shares for $90. I paid to buy the right to buy. I got paid something for the obligation to sell. That reduced my buy price, increased my return. And the move, I think we all saw it, must have been Tuesday earnings came out. Buy will gap up Wednesday. Friday it gave back some, but it still hasn't violated any sell rules, and that's why I'm still in what I'm left. And in a little while, we'll talk about this week's chart of the week. So, introductory comments, which I've already done. We'll go look at the market, top-down analysis, look at some stocks. I will be. This is not a bullish report, by the way. I didn't find a lot of stocks that I was all over to buy. Upcoming live events, October 16th through 18th. Greg Mills holds it's a really nice meeting. It's at the Holiday Inn in, I think, Anaheim, right by, I'm not sure if it's Santa Ana, I think, right by John Wayne Airport. It's an inexpensive meeting. George Lee is the headliner. I will be speaking there, and I've invited Gil Morales as well. Hopefully he'll be able to attend. The following weekend is the famous PV meeting with Ron and Ian. Unfortunately, this will be a rare one that I missed because I have a wedding to go to in Philadelphia. The meeting is still on. I think Ian is very much looking forward to getting back up in front of the audience. It's a great place to go, and if you've never been to one of these, and if you've been to several, I highly recommend it. And then the following weekend, and I hate that these are 3 weekends in a row, John Person has a seminar in Palm Beach Gardens where I live, and he's invited me to speak a little bit as well. So I love the opportunity of introducing what we do in HGSI to his users as well. So let's move on. Oops, don't want to see that one yet. And this is not as high probability trade as last time, although I still think the trade's going to do fine. But we'll get to that in a few minutes. So let's look at the week we had. It was not a great week. So this is 2 weeks in a row that I think it was a tough week in the market. And I think the Dow's been down 7 days in a row. So you might have a reason for a bounce, hence why I lightened up my shorts substantially. And what do I mean by lightening up shorts? If I own a call that's in the money, I might sell the call and just keep, or rather, if I own a put rather that's in the money, it goes up when the market goes down. So I either will sell the put back and put the money in my pocket. I might write an option against the put that's in the money, put some of that money in my pocket. There are a lot of different things that I can do. I did a number of those things to protect the profits that I have on the short side. I am not 100% long, but I was way overweighted to the shorts this week, and at the end of the week, it was time to unload some of those. Couple of things here. Some black, but mostly red. That means the market as a whole was down. If you look at things that you might be looking at, the S&Ps were down 1.25. The HGS 100 was down 1.6. The IBD 50 was down 1.6. The GIF All-Stars is using the group inclusion filter in HGSI to find the best stocks. It looked just like the HGS 100 was down 1.6%. I pick stocks that are like these to put on a buy list. They don't always do well. I don't buy them unless they act well. And my buy list, to use a common word from this generation, sucked this week. It was down 2.25%. What's kind of interesting is I take that buy list and I filter it through John's person signals, and I end up with called my filtered buys. And I still had mostly negative, but I was up 0.5%. If I can be outperforming the S&P by 1.75%, I'm very happy to be up 0.5%. So I really believe in some of the stuff I'm learning from John and the signals that I have in TradeStation, but I don't do them by themselves. I do them in my own way of combining them with the HGSI and other things that I do. There was no Hindenburg. There has not been a Hindenburg in a while. There was one on July 23rd, but the last time was in June you had two. And why is this important? This would go more in the camp of there's not a giant correction yet, because typically we see Hindenburg fire prior to a major correction. That is until it doesn't. What's kind of bothersome is we're heading back up to 10% on the new highs, the new lows in the NYSE. That's a big, big, big number. You can see the new highs are only 1.53% next door. We've gotten up as high as 14.5% on that number, so we'll see where we go there. The buckets, bearish sentiment, a little bit. You have over half the stocks in S&P 500 below the midline. They're Bollinger Band. If I made buckets, these are where the buckets are. Here's what bad, so bad it's good looks like, where we had 22% of the stocks below the lower Bollinger Band back on July 24th. Now, July 24th also corresponded to the day after this Hindenburg, when we had nearly 13% of the stocks below the hitting new lows. Where was I? So this is what we're about to bounce looks like. The last time we were above 70% stocks above the midline of their Bollinger Bands in the SP 500, I got to go back to March 23rd, which is about the last PV meeting, which tells me we haven't had a oversold market, or a market that's been that happy now for 4 months. And we can barely get above midline before we start going back down. Speaking of the markets, we had back to red here. So according to the Woody indicator, which is percent B times bandwidth, pretty much across the board, we are in a sell signal again. Whether this can be reversed in one day with some kahunas, it's probably a little bit lagging. But this is definitely not the wine and roses that we saw at the beginning of this year, when you could be long for days on end. We've been in chop, and it looks like we're going into a downside run. Now, again, that can be reversed with some kahunas, which would be a big move to the upside. And how many days in a row do you expect the Dow to go down before some type of a rally? From a seasonality perspective, although August is a difficult season, and I've just ran his performance now in Edge Rater, which looks at the next 1 month from today. There are stocks that have high percentage of seasonality. And so what I did here on the next side is I tried to eliminate those that had any bad years. And these would be stocks that are overly positive in the next several months. And one thing that I did see, there were a lot of base metal stocks, Nevson, Eldorado, Royal. So gold might be something, Yamani, that has some strength here, Seabridge down here. So there's seasonality supporting gold. And if you look through here, here's 1, 2, 3, 4, 5, 6, 9 stocks with over 10% positive seasonality, and at least 11 out of 14 years positive. Here's VHC, 15 out of 16. So if you're a seasonality fan, there are some opportunities in the market right now over the next month that perhaps you might want to take a look at. To me, technicals trump seasonality, and I'm probably more concerned right now about the overall risk to the market. To the downside, interestingly, despite where we might think of August or September as tough months, if you only look at stocks that had less than 3 out of 12 bad years, good years rather, so you couldn't have more than 3 good years, these are the only stocks that were heavy to the downside, both in number of years down and percentage of years down. All right, now let's go into TradeStation and look at my Johns and Elder indicators on the markets and comment. This will be a broken record, I warn you. We'll start with the NASDAQ. So we've done this before. Elder teaches us a couple of things on these charts. If it's red, it tells me the buying window's closed. I can be short, I can be holding, I shouldn't be initiating new longs. If it is green, the selling window is closed. I could be buying, I could be holding, I should not be initiating new shorts. So the color of this bar represents the Elder impulse indicator on that time frame. If you see a little dot at the bottom of the bar touching the bar, those are some MACD divergence semi-automatic scanners, and they're looking for evidence of MACD divergence. The little magenta dot and the little cyan dot below, those are person's buy and sell signals. Not that the high jump is a concern right now. Here's the high jump. And the way I do high jump is I calculate a number, I compare it back 200 bars, that's what I've got it set at right here, and tell you what percent the high jump is compared to the last 200 bars. I do the same analysis on weekly and monthly. So NASDAQ, it's red, it's in a sell, it's red on weekly. NASDAQ overall is weak. Be careful initiating new longs. Why did I get a little bit less bearish? Because it looks like we've got a doji forming here with a long leg or a long tail that says that that could be a reversing type of a candle. It may not be. I look back here, same pattern at the same place, and we reversed. So the NASDAQ, I got less short because of this candle that was forming during the day, but I'm not saying we're out of the woods. We might be. The Dow, again, stopping candle-like but still red in a sell signal at the bottom of the channel. And notice that on the Dow, we have lower highs, and I got lower lows. And in my world, that means we're now in a downtrend on this Dow. I'm not a great writer, but it's pretty clear that we are no longer in an uptrend on the Dow. So we're in a sell signal on the Dow. S&P 100, again, sort of looks like the NASDAQ in that you had sort of not quite a hammer here. You're red, you're in a sell, but you came back some at the end of the day. Again, we've done this before. We've had several down days in a row. The semiconductors, which have been the weakest, actually bounced on Friday. Now, these are the green dots here that told me that we were setting up some MACD divergence and that I should be looking for a bounce coming in. And we got the bounce. Still in a sell signal by person. We're now blue, which is more neutral. And you could see we've gotten deeper and deeper, and the MACD histogram has gotten positive. So that's a positive signal, but it tells me we're going to reverse probably sooner than later, but we're still red on a weekly and red on a monthly. We still got a ways to go. If I look at the cash S&P, long tail, bottoming tail, but still red with a sell signal. The E-mini futures look the same. Hold on one second. My wife's having a shortage. Okay. All right, so we got the E-minis are red on a sell signal, red here. And NASDAQ 100, the NQs, you could see also red on a sell signal. The Russell futures, red on a sell signal. But notice the MACD divergence coming in here, the histogram, not the same pressure to the downside. So you have a lot of things here that are not looking pretty, but suggesting that we're getting close. Here's the IWN, the ETF, looks just like the Russell futures. Real quickly on the sectors, XLB, materials, red, in a clear downtrend. Energy, red, in a clear downtrend. Financials, still green. I think the REITs sit in the financials because the REITs look strong, so did some of the regional banks on my list this week. Green on the daily, blue on the weekly, so XLF still looks okay. Industrials, XLI, red on a sell signal. XLK, technology, red on a sell signal. XLP, staples, a new fresh sell signal after a new high. Notice the MACD divergence coming in on the weekly, sort of suggesting that we were getting to a topping point. Utilities, they had been lousy. They're not lousy anymore. You got a buy signal in green. So clearly on my list that I looked at this week, there were a number of utilities that look good. Healthcare, XLV, has been a leader. Is this the bottom? I think it might be. Okay. I think does not mean I know. I think it might be. That is a bottoming tail that looks like a reversal, but to me, a hammer, almost a jackhammer in the land of John Person. However, it's still red, and it still is on a person sell signal. I'm going to put these on potential buy watch, but they're still red, and I have to see that change. That could change early in the day on Monday. XLY, discretionary, also sold off this week. But looks a lot like healthcare. Maybe that was a quick snapback, and maybe they're going to bounce. So looking at this, you see a lot to like. Maybe in the financials, I saw REITs, and maybe it's utilities. How do we say the word defensive? That's it. All right, let's jump into HGSI. So I'm going to go into the Woodward and Brown groups down here, and Major Markets Plus, and we're going to look at, I'm going to put on the top-down view, which is all price and volume, heavily weighted towards Friday in the last week. So leaders are utilities, bonds, and dollars, and gold, miners, and silver. When have you seen the market strong when you see that? Does the word never come in? That tells you an idea of how weak this market is. Doesn't mean it can't bounce. Let's look at the key indexes. S&P 500, as we know, down 1.2 on the week. So here is my view. It shows that you had kahunas come in on Thursday. You had that on a number of indexes. We're going to get out of that, but those are a momentum move to the downside. You notice these drawings. And these drawings have been this range here has been my support, and this range here has been my resistance. So where did we stick our little tail in on Friday? Into support, and we bounced off of it. So are we just another time in this sideways correction where we've pulled back to support and we're going to bounce? We're also pulled back and hit the 200-day moving average, which I showed you in Thinkorswim. We're still in this box here. This was a trading range that I put on the chart a while ago. And as long as we're in this box, I don't know, it's going to be bouncing around, and we're right in the middle of the box. We're at a place that looks like we should go up from here. No guarantees. That's why I lightened up my short side. If I look at the Dow, as I did in the other platform, we are in a downtrend. We are getting close to the bottom of the channel, and one would hope that perhaps we bounce here or in the next 200 Dow points or 150 Dow points. Notice the Bongo weekly and daily are in a sell signal, which occurred about the same time as we went into a new lower highs and lower lows. The Dow is weak. If you think about the Dow, you can break it down into the utilities, which have bounced. And now we're coming up against resistance at the 200-day moving average. You do notice that the Bongos have turned green. And you have transports, which have been a mixed bag. Trains remain weak. Airlines have had a couple of good days. But what we see here is something that's a change, is we now got maybe higher lows and higher highs. So maybe transports are resuming an uptrend. Still early, but they've come off their lows. What about the NASDAQ? I would say the NASDAQ remains in this range here. And it remains in the center of its range, closer to the bottom. And maybe the NASDAQ is getting at a place where it's going to get close to bouncing as well. To me, I certainly hope that we don't get down to these levels. So we're getting close to that support line. And then the Russell 2000, which like the Dow has broken through support, remains in a downtrend, looks just like the Dow. Will it bounce from here, or is it going to wait till it gets down to the bottom of the channel? We'll find out this week. Not healthy. Not healthy. Let's look at the dollar. I wish my markets looked like this. Sitting on the 17-day, a little bit of a pullback here, but clearly higher highs, higher lows. So in a range to the upside. The Bongo weekly still being negative. Let's look at more data. All right, and then let's look at the VIX. Despite what's clearly been increasing volatility in the market, it's been tough to make money on the VIX. This is what low looks like, around 10.5. This is what high looks like at about 25. And we're stuck less than 14 and failing to break above the 50. So if you want to put something, on the case of maybe this market goes higher, besides some of those MACD divergences, you could put the lack of participation by the VIX. Perhaps people are discounting this move and are expecting a move back up. Gold, trying to bounce here. Now, hard for me to get that excited by a shooting star, not really a shooting star at the bottom, but it traded up to resistance of the 17 and pulled right back. Hard to be excited by that, but it was up on the day and on the week. Gave us a nice big doji. I think what I get excited by gold is seasonality is strong. That these two dojis in a row might be evidence of some bottoming. But then again, where is gold going to go? 115, that's a 10% move, I guess. Used to be support. That's going to be pretty tough resistance. Right now, that's about where the 50-day moving average is, but that average will continue to drop. Gold has some seasonal strong coming in. It might be another defensive place to stay. And then silver looks just like gold. So, I know I'm making you excited here and finding you lots of places to put your money. We'll spend a couple seconds looking at some of the contras before I go to my chart of the week, which I thought about making a contra, but I do think we're going to see a bounce this week. But what do I know? The markets are going to do what the markets do. 173 index groups. If you look over just a weighted price and volume view, you see cement at the top. If you go back 2 or 3 weeks ago, I called out cement, and cement's had a great performance since that point in time. And the only reason I called out cement was that several stocks in the cement group, U.S. Concrete still doing well, Martin Marietta, Vulcan, all were at the top of my review, and I thought that was a little weird. All right, so let's see what I got to do here. Let's look at how many groups are moving to the upside. 13. How many groups are moving to the downside? Here's some indecision for you. 16. So really about the same. Look what's negative right now. Oil exploration, services, integrated oils, and refiners. Is energy still weak? Yeah, so be careful. Every time I stick my nose into energy, I get my nose broken. Steel had a couple strong days, and now it's down on the bottom list. Chemicals, mining, marine shipping, which I saw some stocks that actually look good. The problem with marine shipping, it's sort of both ore stocks and oil, and the oil and the ore may behave differently. If I look at the 2-day ups, you'll see some defensive stories. Utilities, cement still here. Utilities, auto parts, metal miners. So let's take a look. Not the typical technology plays except for semiconductor devices, which is interesting. So we'll look at these. I right-click, change the next group. So I did put a number of energy stocks on my buy list this week to watch. Hard for me to tell you which one to buy because they all look the same. They all look like are stocks that have been in a downtrend, many of which had kahunas on Friday. Here's a mobile breakout from a squeeze, and Duke Energy, it pays a 4.2% dividend. But let's not forget the amount of overhead supply and resistance it's going to have to get through this 200-day moving average. If you look at a weekly chart, everybody who bought between the end of May and October of last year is a loser on their trade right now. The stock's been in a pretty tough downtrend, as have most utilities. So I think they'll have tough time getting above this level, but a Kahuna, all the other indicators look good, and I think what I just said is indicative of utilities. Exelon has to get through the 50. Southern Company about to break through that 200. This will be interesting to see what happens. If it can break above the 200 and retest, pays a 4.8% dividend. But you can see these are all been in downtrends. Here's one that just broke above the 200. Don't know this company, PEG. I'm not going to go into all of these, but several of them made my watch list, and they made my watch list because they look like Duke Energy with momentum coming in on stocks that have been beaten up that pay a nice dividend. Strong group, hard for me to believe that's leadership of the market, but that tells you the market that we're in. Internet media. Now, Baidu sold off hard on earnings, and perhaps it's trying to make a recovery. It's got a huge gap to fill. Don't like the earnings per share growth. Maybe on valuation, somebody thinks it's cheap. But boy, this thing failed miserably at the 200. Had a low close doji on the day before earnings. Here's your doji, here's your low close doji, and just tanked. Here's the earnings day, and then it just tanked. Pretty ugly chart pattern. Pandora, interestingly with Apple Music, Pandora sticking its head above the 200-day moving average. Did have a topping tail a couple days before. As far as charts go, it's about as good as I saw. I just worry about their competition. They had a good earnings report and came out and talked about their subscriber growth. I don't know Pandora very much. I like Rhapsody and I like Tidal, and I'm trying out the Apple Music. The reason why I like Rhapsody and Tidal is because I use Meridian for my audio gear, and I don't have to buy albums anymore because I get high def music through just by downloading from those services. They have high def streams. Auto by Tel. This chart could have been on my chart of the week. It wasn't. I don't know why. I didn't find this one earlier. Add it to my buy list. So let's look at it on a weekly. Yeah, it's pullback, cup, handle, breakout. I mean, I'm squinting. Curious if MarketSmith called this anything, ABTL. Well, it's got some earnings growth coming in, and I guess they're looking at it as a potential cup here too. And MarketSmith, let's go to a weekly chart, sort of put a target on it. About 21 to take profits. Not a bad looking chart. So Auto by Tel, and I'm just curious, ABTL, let me go into my screener here. ABTL. Obviously just had a big move, and probably too big of a move. Weekly buy signal on John's stuff. The reason why it's not a high close doji is because the stock was in an uptrend. Certainly looks like it could have been a high close doji. OBV leading, my indicators firing, popping out of a squeeze. I like it. Maybe this should have been my buy of the week. Auto by Tel looks interesting. And then there's the index, why buy things that are performing worse than the index. Cement and aggregates. Many of these have already had their run. Hard to get excited about Cemex. It's been in a long-term downtrend. U.S. Concrete, a different story. Nice uptrend. I talked about it here. is when I think I started getting my signals. You could have talked about it down here as well. And it's breaking out here. It's just had a big run. It's up 30% from when the run started. The high jump is at the top of the bar. Everything is green. You missed it. I missed it. Next. Enough of that. Let's see if Vulcan's on my list here. Martin Marietta is just an expensive stock, but it too, right about here, you had a Eureka tell me the markets had gotten up out of a squeeze with the Kahuna and a pocket pivot. So if we go back sometime around middle of July is when I started talking about these. Casinos and gaming. Yeah. I didn't pick one of these as my stocks of the week or charts of the week because they're all in downtrends. For a while, every couple of weeks, I'd see negativity coming out about Macau. And if you're Wynn, if you're Las Vegas Gaming, and especially if you're MPEL, you depend upon Macau for your survival. And you see stocks that have run from the 45 range down to the 18 range. And this is a weekly chart. Here's my little pattern. What goes up comes down, and then maybe it's going to go back up again. It's clearly the sentiment has changed, so you might want to nibble here. Remember, these are not low-risk plays. You're still heavily dependent upon Macau. MPL, no earnings per share growth, pays a little dividend, broke through the 200-day moving average, had a couple of kahunas last week and some pocket pivots coming out of a squeeze. That might be a place to start. Wynn, you could certainly argue that Wynn has been basing now for 3 months, 2.5 months, and had a PSAR reversal and a mobile breakout out of a squeeze on Friday, well below its 200-day moving average. But the benefit of this one is you could probably come in and put your stop at around 95, and have a legitimate place to get out at. I don't like buying downtrends. Look at the industry group. That's interesting, isn't it? MGM, big move this week. Las Vegas Sands, similar, I think, in scope to Wynn, might be the one that I go for of the three. I don't like their lack of earnings per share growth. I do like a 4.6% dividend. I do like their volume. I do like the PSAR reversal out of a squeeze with a couple of kahunas. Let's just look at this on my screener. Person buy signal on the daily. It's in a weekly buy. OBV is strong. Monthly buy. I like it. I think that pick your poison, whether it's MPEL or Las Vegas Sands. I think I'm interested in Las Vegas Sands. I love that dividend. I like the chart. We move on. That's why I do this program. Caesars, too much litigation issues. Isle of Capri, I strongly consider this guy for my chart of the week. It's clearly in a long-term uptrend, pullback to support. It's my favorite setup, sitting on the 50, mobile breakout from a squeeze, great earnings per share growth. It just doesn't have momentum coming in yet. I need that kahuna. So if on Monday the stock takes out the PSAR dot and has a kahuna, I'm in. So this is a setup. I call this my pullback to the 50, waiting for a signal. And actually, just to show you what I do, which is probably anal, if I can use that word on the tube, I break out my buys into categories, and you should see pullback waiting for a signal should have, who is this? Isle of Capri. There it is. And so I'd be scanning and looking for that signal, knowing that if a signal comes in, I want to buy it. So Isle of Capri also is interesting. Chart looks 1,000% better than Las Vegas Sands. Up, clearly an uptrend, pull back to support in a squeeze versus a stock that has been on a monthly basis, a weekly basis, has been in a big downtrend. The difference is I'm buying this guy kind of off of a base The Isle of Capri has already had a big run. This is the big kahuna, and I like that 4.6% dividend. Semiconductor devices, these have been beat up. And yeah, we'll look at the first couple because there's a couple I like in here. NVIDIA. NVIDIA had a nice earnings surprise. So we had a Bible gap up on Friday, closed in the upper third of the gap up. You could buy this on Monday using Morales' and Catcher's rules for Bible gap up. Had a kahuna coming out of a squeeze with a mobile breakout, a squeeze with a Bible gap up. Everything is green. I look at the weekly charts and I see that a pullback to support on the weekly and a breakout. This is the old highs, not far away. I like this. I think this chart looks good. I would have liked it more before it got extended. I'll show you seasonality. This was a seasonal play, and I thought about taking it as a seasonal. The market was too sick. So why do I like seasonality? So this is seasonalitytrader.com. Here is the stock. It was in a channel. Here's the earnings day. And I look here and I see if I bought on August 5th and sold on September 15th, I'm up 8 out of 10 years with an average return of 12.6 on the up years. So I had seasonality in my favor. I just didn't like the technicals as it was trading below its major moving averages. Another one that's in this group is Skyworks. And Skyworks also has been, I don't like the channel, it's been going down, but in a seasonality, it's also in an 8 out of 10 period of time. So NVIDIA probably missed it, although I don't think so. I think you can still play NVIDIA. They raise guidance going forward. Here's Skyworks. Different play. Here's a pullback to support. So, it's at the average price of the last 200 days. Put on a weekly. If this was a daily chart, I'd be getting excited. This is called a bingo. It's a baby out with the bathwater. Earnings are out on the stock. Obviously, this is very much tied to Apple from a performance perspective. But seasonality, it's strong. Ambarella in an uptrend pullback to the 50. I like this pattern. It's sort of working through its blow off top here. I think it still looks viable. And Xilinx, I don't know. Group 6, utility networks. PCG was one that made my buy list. And again, remember that Duke was below the 200. This is breaking through the 200, pays a 3.4% dividend. I'm not going to go through them. Take your pick on the dividends. Auto parts. These companies, a lot of these don't like to split. You got the retail ones. Let's take a quick look here, see if anything looks good. Delphi, it's kind of like Skyworks. You're buying it off of support at the 200-day moving average. Had a Kuna pocket pivot, mobile breakout from a squeeze. Pays a 1.3% dividend. Probably a low-risk buy here. Harman International, kind of a messy looking chart. Lear Corp, not as good looking as Delphi, but the similar picture without the momentum story. So Delphi still looks the best. Cooper Tire had some earnings come out, I think, this past week. These are not big growth names setting new highs. We're looking at stocks that have been beat up almost across the board. Metals and mining, talk about beat up across the board. Eventually they're going to come up, but is it time? American Barracks had an upgrade this week. It's kind of at what looks like it's probably a bottom. Let's look at a weekly. Couple dojis in a row, like GLD. But is this a growth stock? Is it a growth story? Maybe it's a defensive story. Bottom fish. AEM. And now, let's look at Royal Gold just from a seasonality perspective. I said that gold looked good on using EdgeRater, RGLD. And you have that same issue, which is it's in a fierce downtrend, and it's going into part of the year where it's got 8 out of 10 positive on seasonality. Gold making it to the top of this list tells you that gold is rotating into favor, at least on a short-term basis. But these are stocks that have been beaten up, and if you want a bottom fish, be my guest. Home builders, I don't know anything about Williams Lyon, but that was the one that impressed me the most. You notice that the big guys aren't up here until you get to Toll Brothers. So let's go very quickly and see. Pull back to support, kind of a topping tail on tri-point, no thanks. LGI broke out after being in a squeeze for a long period of time. Great earnings per share growth, no dividend, 200,000 shares a day, not a lot of volume. Don't know this guy at all, less than 150,000 shares. Again, low volume, but great earnings per share growth. Hard for me to get excited by any of these with 200,000 shares a day. And Toll Brothers, I don't love them, and I certainly don't like the ones at the top. They're too thin. Healthcare services, this was a buyout. Let's just go through the top couple, see if any of them look good. LHC Group, breaking out. Air Methods, ambulances, China Cord, blood. I'm not seeing anything I love here. This one looks good. Chemed. I don't like the earnings. I'm just curious. Let's go look at. I don't like stocks that have PEs 23 and their growth rates getting into the single digits. I think it's expensive. I'm going to not take this one. So I've gone through the upside. Let me look at some of the contras that you can take if this market turns down again. The Dow is the weakest. So the upside is the diamonds. That's a ETF. The dog is a contra ETF that goes up when the Dow goes down. So you could see a reversal potential day on Friday, which is why I lightened up on my contras. But you could see it broke out above the 200-day moving average. OBV's turned up. Everything is green there. So if you want to play the dog to the downside, the Dow downside, dog works. In my experience, it doesn't move enough to make me happy. IWM is an ETF for the Russell 2000. Broke below the 200-day moving average. Again, could be a stopping candle, so we'll have to see. Now, what if I wanted to play this to the upside? I want to play the fall. I could buy TZA, which seems to want to break out here, but it's got some major resistance ahead. Here's the problem with owning. This is a direction. This is what I usually play because of its liquidity. But these are not, you don't buy these to own them. You buy them to play a short-term move in the market. Because all the reverse splits, you have a high of this stock of 9,316. And it's currently trading at about 10. So these are great for short-term market corrections. They're not investment advices. Let's say you look at the spiders, and you don't want to buy a $200 ETF, so you could look at SOXL, which SP. Let me get this right. Hold on a second. I can't remember all these sometimes, so I go over to my cheat sheet. SPXL and SPXS. Here's a long, if you think the S&P is going up, certainly it's sitting on support. Here's SPXS if you think the S&P is going down. Kind of looks like TZA. So there are ETFs that will give you 1x, 2x, and 3x performance either in the direction or the opposite direction of these major indexes. Let's say I think that semiconductors are going down. I could go long SOXS, which is will behave the opposite of the SOX. Or I think they're going up, I can buy SOXL. So there are ETFs, many of which are liquid, many of which are optionable, that SOXS is not a liquid one, SOXL is. TNA is a long of the Russell, very liquid, 4.5 million shares a day. So there are a number of ways that I can play to the short side. I could buy several of the ones that I showed you, or I can short the ones that represent the upside movement of the market. I have a list of them here of some of my favorites. On the bullish side, Cure for healthcare, Energy is ERX, Finance is FAS, JNUG and Nugget are long gold, Midcaps MIDU, SOXL the semi-long, SPXL the S&P long, and TNA the Russell long. On the short side, Dust and JDust for gold and junior gold, ERY bearish on energy, TECS bearish on technology, TZA bearish on small stocks. And I look for signals just like everywhere else on these and look for reasons for me to be jumping in as well. So I'm getting tired. Let's go back to my PowerPoint and talk a little bit about charts of the day. It wasn't easy this time. I chose CONE. I chose CONE because it's in the financials REITs, which is one of the strong groups. I chose CONE because it looked like a low risk opportunity. It is, let's pull it up on HGSI. It's funny, when I ran it earlier on my other machine, I saw REITs in here. No worries. CONE. It's not an old stock. It's a relatively young stock. IPO in 2013. Been in a nice long-term uptrend. I go back to the daily. I love the earnings per share growth. Let's look into MarketSmith. It's growing faster than the PE. Okay. One thing I don't often talk about is the float. And where's the float on this guy? Float is 62 million shares. Floats less than 100 have a great chance for getting a big move. In a defensive period of time, it's paying a 4.1% dividend, which is a nice dividend. Average volume is 760,000 shares. And I'm not a big believer in shopping centers anymore, so I'm nervous, which is probably way too early, about REITs that are shopping center. But this is providing enterprise data center, co-locations, engineering facilities, highest power redundancy, and power density infrastructure service in the U.S., I like that because as we become more of a connected society, there's going to be more needs for these colos and enterprise data collection centers. So I think it's in a good industry. It certainly has been in an uptrend with a pullback. It's sitting on major support. Mobile breakout from a squeeze, a pocket pivot, and a kahuna. And what I really like about it is, it hasn't seen its 200-day moving average in a long time. It's bounced off of it a couple of times. So I can feel pretty good picking some spot in here, maybe around where the 200 is, or below that PSAR dot for a stop. So I see a stock that's in an uptrend, pull back to support at a low risk entry and that's why I put it on my chart of the week. I doubt it will have the same bounce as AMSG did, and its earnings are already out. So from a trade consideration, here's just the right-hand edge. Closing price was $30.81, which was the high of the day. The lowest recent close is about here, which was $29.16. So I will set my parameters on this stock is if it takes out yesterday's high, which is $30.85, or as being my buy point, Friday's high, I'll put my stop at $29.15. I'm risking $1.70, which is 5.5%, and for every 2,000 of risk allowed, I can buy 1,175 shares. Note, the market is not supportive of a long position, so this is not without risk. However, these have been outperforming. Number two, there is a triple top in the $33 range. I have to be aware of that. The triple top occurred right after one after another as part of this trading range. So I'm going to plan on taking $1.70 off the table at $32.55, and then I'm going to leave half of my money running and take my stop to break even. So, as last week, I could buy stock outright. I can buy a call. I can do a bull call spread. Again, buy a call and sell a call to offset some of the call cost. I can do a bull put spread. I can sell a put to generate income and buy a lower one for protection. I can do covered stock, buy stock, sell a call. I could do a synthetic, or I could do my synthetic with a put below the short put for protection. I elected to do the two things in green, either buy a stock outright or buy a call spread. At the end of the day, I'm going to talk about why an option trade looked good, but here's why I'm not doing an option trade. This is the amount of open interest on the September calls. There's like no volume. So what does this mean? It means I'll never be able to sell it until expiration, or I'll have to sell it at less than its intrinsic value. I don't like doing that. So my considerations were, if I bought a $30 September expiration call for $1.20, and then I can sell half at $32.50 anytime before the third Friday of September, I would get 100% gain. And this, I had to move just a little bit from 31 to 31.21 to be profitable. I think that's a 19% move. No, 1% move rather, to break even on this trade, which is good. This is my limit for risk here. Here's my opportunity for gain. And if I can get the stock to move to about $32.50, I will have a 5.2% move on the stock and a 5.2% movement from my strike price, rather, less than a 5.2% movement on the stock. And I'll make $1,000.85 on a $1,200 investment. I'm just looking at 10 calls. So I paid $1.20 times 100, because it's 10 of them. So I paid times 10. So I paid $1,200 for the call, for the 10 calls. If I can get to $32.50, I will make $11.85. So I almost make a one-to-one return, 100% return. And all the stock has to do is move to $32.50. So for a percent return, that's a great return. However, volume on the calls is low. I may be impossible to get out, may be tough to get in. It doesn't pay a dividend, but I can control 1,000 shares for $1,200. If the stock trades down, my call becomes worthless if it doesn't trade above $30 by the third week in September. I could also buy stock at $30.85. Here is the P&L curve on buying stock. The difference is I get the same or similar upside as the call, but on the call I can only lose what I paid for the call. On the stock, I can lose money if the stock drops. To control 1,000 shares, I don't spend 1,200, I spend 31,000. Now, the good news is it's much easier to get in and out. They don't expire, and I keep my dividend when it gets paid. If the stock moves to 32.50, I will make $2,166. Make sure that makes sense. That doesn't seem right. Maybe they're using a different closing price. If I buy it at 30.85, it moves to 32.50. I'll make $650, not 21.60. The call. So that's an error. I apologize for that. If I buy it at 31.80, excuse me, I'm thinking the other thing. If I buy it at 30.85 and it moves to 32.40, it is $1.60. So I'll make $1,600. I won't make $21.66. So $32.50 on the stock will be up $1.65 on 1,000 shares is $16.50. So I will make more money at $32.50 on the stock than I will on the option, but my cost of controlling those shares with the option is a whole lot lower. However, in my experience, the likelihood of getting a good fill on the in and the out when there's no volume is extremely low. In this case, I take the stock. I have a stop that will limit my risk. As we talked about up here, my stop will be at 29.15. So at 32.50, I'll be up $1.65, which means on every 1,000 shares, I'll make 1,650. I'll take off half at 32.50 or 32.60, whatever the right number is, and I'll let the rest run, and hopefully I'll benefit from a 4.1% dividend. Let me just go over my candidates for the chart of the week, and then I'm going to say goodbye. NVIDIA, we've already seen. That was a nice time to buy it at $10. NVIDIA, Bible gap up this week. Probably, well, I won't say it's too extended, but it's extended. I'd like to see it base a little bit or come back in before I follow it. But according to Bible gap up rules, you could buy it and set your stop here. So you could get in maybe at $23 at the open with the stop a little bit, maybe at $21.50. So you're risking about 7%, but you need to know how to play Bible gap ups by reading their book. American Health Services, this would have been a perfect setup on Tuesday, gapped up on earnings on Wednesday, gone sideways since, probably also playable. It hasn't had a big move. It's midway in the Bible gap up channel. You could set your stop a little bit below the gap and take it here. Great earnings per share growth coming in. AAOI earnings are also out in a very nice uptrend this year despite a sideways market. Broke out this week above prior highs. Had a kahuna on Thursday. That's the earnings day. Bible gap up out of a mobile breakup from a squeeze the prior day. Everything is green. Great earnings per share growth. I seriously considered this one for my chart of the week. Papa Murphy's Holdings, again, a beautiful pattern, uptrend, sideways to the 50, mobile breakout from a squeeze and a kahuna. Looks just like the AMSG. Problem was earnings are coming out this week. Masterich Company was another REIT. These guys own shopping centers. Good seasonality here. Earnings are already out below the 200, but certainly resuming an uptrend. I passed on this, but I did notice a great earnings per share growth. These are shippers. These are marine shipping. As I mentioned, in marine shipping, you have dry bulks, like dry shippers, which have been in the penalty box, and you've got oil tankers. The oil tankers have looked interesting for a number of reasons. It costs $1 per barrel per month to sit in a tanker floating in the Gulf of Mexico. When storage becomes used up and you keep producing oil, which is going on, you have high demand for sticking the oil in the tankers. The cost of running a tanker that's not going back and forth to the Middle East has got to be a lot less than when you're just sitting in the Gulf of Mexico. So what's happening is a lot of these marine shippers on the transportation logistics of oil world, not the dry shippers, are floating around doing nothing but storing oil. That's a high revenue, high margin business. You could see the earnings per share growth here. A 5% dividend. This is a cheap one. It's just had a PSA reversal and a mobile breakout on Friday. Everything is green. I thought that chart looked interesting. I could have put one of several others in there. Bank United is a regional bank going sideways, pays a 2.3% dividend. Mobile breakout from a squeeze a couple days ago, still in the squeeze on Friday with a pocket pivot and a kahuna. Sideways chart, nice looking bank. This was a little bit looser, but it really had a lot of great signals on John's stuff. Pull back to big support at the 200 and a kahuna and a pocket pivot on Friday off of it. Has to get through the 200, Ritchie Brothers. Kind of a different looking chart pattern. A little bit loose perhaps, but bouncing off of 50-week and 200-day support. Here's that CONE, Cyrus 1, that I picked as my chart of the week. Barnes Group, another stock. This one, older company, corrugated metal, fabricated metal. Been going sideways for a long time, so I decided that although the daily chart looks like it might be breaking out, it's been in this range for a long time. Nevro, a young biotech company, sideways. Mobile breakup, a mobile breakup from a squeeze, a pocket pivot, a kahuna off the 50, and a PSA reversal. It's the pattern I like to see, but it keeps doing it and falling back into it. It's not a cheap stock, so I like the pattern. Wasn't my choice of the one of the week. So these are for demonstration purposes only. And I want to talk through why I picked them, where I set my buy and sell points, whether I'm doing stocks and options, and why, more so than I want to expect you to buy them. This is education only. I will say to a negative is CONE is not giving a daily buy. It's in a daily sell on my persons, which is right here. It's in a weekly buy. It's in a monthly buy. Now, John doesn't really tell us what the criteria are to turn into a buy. My guess is if we open up on Monday because we're above the pivot moving averages, that this will shift to a buy signal. What I also like is look at my weekly volume. My weekly on-balance volume is the highest it's ever been. That tells me that I'm very likely to go back and retest my highs. And remember, my takeout half off is 32.50. That gets me up to closer to 33. So I liked it a lot. I'll be looking to see if I get that buy signal, and we'll go from there. Again, educational purposes only. I had a couple of texts come in since I've been sitting here. If you're a PUG member, you've got your mini mentoring with John Person Thursday night at 8 o'clock, and I will be sending out invite to full PUG members. That means ones that own the indicator package and own HGSI. You all have a great week, and we'll be talking to you soon. Thanks, everybody.